All right, good morning, everybody. So we got kind of a busy week. One of the big drivers is going to be Powell speaking on the 30th at 1:30. It is considered another opportunity to do a Jackson Hole mic drop moment. Now, of course, we don't know if he's going to do that or not. Over the last week, we've seen an adjustment on the potential rate hike. We're at 375 now. Moving from 375 to 425 would be a 50 basis point rate hike. And they've been unwinding that position. And they've been increasing a 75 basis point rate hike. And we see that by looking down here. Just use the week rather than trying to do a day by day. And you can see we were at an 80% chance of having a 50 basis point rate hike. And over the last week, it decreased by, say, 11%. And we were sitting at a 19% chance of having a 75 basis point rate hike. And that has nearly doubled to a 30. So they're trying to price in a 75 basis point rate hike. We're going to want to see this continue to move up and this one continue to move down. The FOMC that it's adjusting for is the December 14 FOMC meeting. Before that meeting, we're going to get CPI, PPI, maybe not PPI, but definitely CPI. We're going to get econ that may adjust this. So far, things have been moving kind of slow. The threat will be if it starts to price in really fast. So depending on what Powell says this week, we could see a significant change in these two bars. And it's something that you're definitely going to want to focus on as we get closer to Wednesday afternoon. And then definitely before we go into the weekend, where are we at on this thing? It's all focused on China this morning, China ADR names, and big names like Tesla and Apple that have manufacturing over in China. This is also directly affecting the price of crude or energy. So there's been that, idea that energy was going to pick up after the elections, since there was a lot of, manipulation going on to keep everything at a low value. That play isn't working out too well. I went the other direction. My argument was it seemed like everybody was positioning long and it just became an overcrowded trade. So, like Tom Sosnoff says all the time, if you don't like my trade, take the other side. Well, I didn't like everybody's trade, so I just went the other direction. You want to be careful today. The ECB's president is going to be speaking. Lagarde, however you say her name. There's a few overseas officials that I tend to pay attention to that have rocked the market back in the day. It was Mario Draghi. Anytime that dude was talking, I would pay particular attention because he could really rock the markets. Another one worth paying attention to is President Lagarde. We do have Bullard and William and Nigel, just the regular run of the mill, and everybody's supposed to continue to sing from the same hymn book. So we're not really expecting any earth shattering revelations out of Bullard and Williams, but just really watch it when she speaks. We do have additional auctions today at 11:30, but we don't have a 1 o'clock auction. So the afternoon 0 day should be a go. There's nothing on there that would pull us back from doing a 0 day in the afternoon. On the left-hand side here, all three of these sectors are presented with this kind of a double top, and it's testing a breakout. Some have a little bit of handle on it, some don't. These are three different sections of sectors, right? The top is our risk on, the bottom is risk off, the middle is midline. So we don't normally look at these in columns of up and down. We look at them in rows from left to right. The XLF is at a pivotal moment here, and it did make it above and close above and hold above the 200 period moving average. So out of the three risk on sectors, that's the only one that actually has anything of strength to it, right? The rest of it it's still underneath the 200. It's still struggling just to hold the line. And even worse, consumer discretionary looks worse than tech. Financials is like the only life raft right now, kind of holding things up. It's doing a lot of the work. And if we lose those financials, we might just finally start to flip over, right? It's like a three-legged stool. Kick one of the legs out of that three-legged stool and it's going over. So really keep your eye on XLF. I like to use KRE just because XLF is more of a hodgepodge of different things. It's got insurance in it and trading desks, all kinds of things that I just really don't want to muddy the water, right? So I look at KRE, which is regional banks. It's more specific in its financial focus. Either way, just keep your eye on the financials. We already know that tech is beaten down now with the ADRs and things getting whacked like NVIDIA, the chip sectors, Apple, Tesla. Sure, we got those pressures. But as we're going to see in a few minutes, the dollar dropped significantly in the overnight hours. And where's our market? We didn't respond to it at all. So we can't look at the dollar as some kind of go, no go gauge, or we can't lean on it like we have been over the last few weeks. There's a disconnect right now. And if we can't look at the dollar, we better be looking at something. If the financials get in line with the rest of the two sectors, it's going to remove this this divergence that's happening right now. And one of the most dangerous things you can have is a highly correlated market state. So a high correlation coefficient is the threat right now. So watch the financials. Behind that, sure, industrials, building materials, consumer staples, healthcare is breaking out. it didn't even wait. It's got the same setup as all these others, but it has already broken out as a leader. As a leader in a part of a capital rotation. All right. So just, yeah. Usually like to start the week off looking at the amount of volatility that we have projected for this week compared to what we had projected for last week. Last week was a 4-day week, and the volatility box was relatively large. I think the market makers are getting this one wrong. This week, we have a 5-day week, and the volatility is much smaller than it was last week. And yet, because of the 30th, the Powell meeting at 1:30, we have the capacity right now for some significant violence. I posted about that meeting, by the way, when I wrote my weekend summary. I wrote down what I consider some of the most important economic events over the next few weeks. I put the link if you want to keep track of what's going on with Powell that day that he speaks. And then, you kind of dig through the rest of this. So right now we are underneath this year-to-date VWAP. It would not surprise me, if we don't get above it for the year. We've been above it before, so just because we get through it doesn't mean anything by itself. It's more of a concept or a perspective of where are we at on the year, above or below the average. We have a gap down on the week. Just jump over to the week for a moment to see this. We don't generally keep weekly gaps for long. There are weekly gaps that are out there. I can show you where they're at, but generally speaking, the S&P doesn't leave weekly gaps on the table. So 4034 is very likely to be tagged. Maybe not today, but it's likely to be tagged by the end of the week, just because it's a weekly gap that needs to be filled. Now, when you're speaking of, gaps, it's easier to use the S&P for this, the SPX. There are weekly gaps that exist. So, it's not some guarantee that we're going to go up and close that gap. But you can see where all the dailies are at. There's a lot of dailies. There's like 1 monthly and maybe 3 weeklies, 4. The rest have been filled because it has a habit of filling those gaps. We're still above the 10-week and trending back towards it, which is kind of normal. We don't normally see a trend back towards the 10 and then a reversal without actually getting back to the 10. All right, you can see where we set a high and we came back to the 10, and then we went through the 10 again. Same thing here. We set a high and came back to the 10. So it has a habit that when it begins moving back towards the 10, it actually gets all the way back there and touches it. And that's the 10-week. It takes time to get anything new on that, right? It's a weekly level. So bring it over to the daily. This one we've seen reversals when it begins trending back to the 10-day and then turns and actually moves away from the 10-day without getting all the way back. So it has a history of doing that. It doesn't have to get back to zero, but it's really close at this point. It's only 0.5% away from the 10 anyways. So you want to be watching that 10-period moving average today on the ES. It's very likely that we're going to interact with it if we continue to stay weak. Even now at this point, we're not bearish. If you're looking for swing trades and you're thinking about running trades into the end of the year, we're still not bearish yet. We don't have a bearish trigger for swing trades short. Not yet. Looking at the volume this morning, it's where we would expect it to be. Not high, not low, not extreme. So we're done with that. We just turn it off. We're below the weekly pivot, and we have an MDP, missed daily pivot. That's not my strategy, but it is an interesting one to learn. Even if you're only going to use it for analysis, it's still a valuable one to grasp at the very least. So if you was to check YouTube, whatever, just search for missed daily pivots. I'm sure you'd find that strategy. It's pretty common. Looking at the retracement levels, we are interacting with 50%. If you look at last week from Tuesday's low all the way up to Thursday's high, that's what we're measuring. And 50% of that is where we were playing around this morning. So we're back above it, but not by much. It's a little bit of a benchmark. We need to hold above that as like a primary level. So I talked about the gap down. You can see where we closed Friday, where we opened Sunday. A lot of times we'll run right up and close that immediately, and then we'll do something else. It didn't do that Sunday. It opened and just continued to drop. When it tried to retest, it couldn't even get back up to the open, which is really weak. So right now we've got a significant pivot point at the open, 40.20. We have the cash open of Friday, 40.27. The Friday's close, 40.34. The daily pivot, 40.36. The RTH high, 40, we'll call it 40.40. The high of yesterday, all of it, 40.45. Breaking out of the previous week's high at 40.49. ADR half at 40.60. And the ADR full at basically 4,100. That's a long ways off. To the downside, we need to get through this Globex low, 39.92. ADR half, 39.80. The ADR full, 39.41. And then we would be at the previous week's low. So right now we're inside day breakout. As I've talked about before, depending on who your broker is, sometimes you're better off just putting all of the holiday days together. And this is something we go through every year at this time. There's going to be a lot more holidays. All right, we got a lot of short weeks coming up. So you're going to want to get familiar or comfortable with how are you going to deal with this data. And every broker kind of screws the data up. Right. So one thing that you can do is focus on Wednesday. It was your last full day. If you focus on Wednesday and you treat everything else that's happened since then as like a Globex value, then you don't get too hung up on where it opened, where it closed, and all of that, which really leaves a gap behind. If you think about where we closed Wednesday night and where we opened Sunday night. Now, we're just talking about aggregating data. Obviously, there was opens and there was close and there was price movement. But Wednesday's still the controlling candle. So if I'm looking for an inside day breakout, I want to see it outside of Wednesday's level. And we made it out. But it looks like the Busby failed and we're getting back inside Wednesday's level. Just to show you kind of how crazy things get on short days and short weeks. Look at the cumulative tick. That is like pixie sticks. It doesn't make any sense, right? It's kind of crazy and weird. Ten-day, 30-minute volume profile. If we was going to try to make another run back up, we've got a significant level of resistance at 40.34. To even get there, we would have to get through the open of last night and then through the close, which the close of Friday really does line up with this volume that we're talking about. So getting through Friday's close and above it would be tricky. I think we would really need some econ to get us up there, or some solid news, right? It doesn't have to necessarily be econ, but price alone right now can't do it. We're going to need a galvanizing trigger to push us up there, or we're not going to get it. Instead, we're going to continue to look at what we would normally look at. When we're at the top of the box, we expect to go to the bottom of the box. When we're at the bottom, we expect to go to the top. Point of control is at 39.74. And right now, if this fade continues, that would be a place I would look as a target. There is an untouched point of control from Friday. I don't know how much value I want to associate with it, since, you know, it's one of those half days. But one, we want to continue to do things the way we always do them. So we'll bring up the VPOC there. Two, you know, it's free. It doesn't cost us anything to put it on there, and just keep track of how price comes up into that level. If it gets there and it runs right through it, so what? It didn't hurt anything, right? It's not like we're going to take a trade just because price got to that point. We would want to look at it from the idea that if price gets there, it's very likely going to react there. Pause, consolidate, bounce, reverse. It's very likely to do something when it gets there. So it's worth marking. And then if, you know, if it doesn't, then fine, nothing. No harm, no foul. $40.34 is the level that you're going to want to mark. That was the close of the week from last week. So here on SPY, we measured that really big candle like we generally do. It was this really big day here, 11-2. And we plotted that really big candle up 50% and then 100%. And that has been the line in the sand for the S&P for SPY. And I point that out because it's a really great example of measuring big candles and using it to kind of give you an expectation of, what's going on with price. That is a part of a big gap level that needs to be resolved. It's where we closed, at 411 basically, and we opened at 401.83. So there's this gap channel up here that needs to be fixed. But we got hung up with that really big candle and just haven't made it through. And that's still in control. But we're not weak yet. We're not bearish yet. You don't want to short this yet. And starting a week gapped down is not necessarily bearish, right? It's if you put turnaround Tuesday into things, you get your gap down on Monday, get a little bit of weakness, solidify in the afternoon, basing along those lows, begin the gap up on Tuesday, and then it's like a slingshot, right? Just catapults right up through the weekly close from the previous week, and then just continues that run upwards. So don't take today's gap down as being bearish. Not yet. It's not enough. Especially when you bring in the idea that look at what happened in the dollar last night. Right? This thing moved over one point from the high to the low, 106.5 to 105.5 plus some. And sure, I mean, we're down a little bit in the ES and the NASDAQ, but we shouldn't be. With the dollar down like that, that should have brought us up to at least the gap close, if not more. So we're not seeing the effect of the dollar down touching into the indexes this morning. That's a cause for concern. And it kind of highlights, hey, don't do what we've been doing a lot lately, which is watching the dollar, watching the yen, watching the yuan, and kind of getting a feel for, hey, if this bounces, the dollar's going to bounce, the S&P is going to fall. Or if this hits resistance, the dollar's going to hit resistance, the S&P is going to run. Can't do that today. So we've decoupled from that teeter-totter system at the moment. At 40.21, we have a moving average. And at 39.92, we have a moving average. Now, both of those are on the daily time frame. We've got a 4-period and a 10. The 4-period lines up really close with where we opened last night in the Globex. So it's not just the idea that it's the 4-period. It's one of our open, high, low, close for the week. That 10-period is kind of more important on the aspect of where we're at, right? Above the 10, below the 10. Keep in mind that's the center of the basketball court, right? So just because we're at the 10 doesn't make us bearish. We got to get below it and close solidly below it before we start considering anything bearish. That is also where the 4-week, so we were looking at the 4-day, this is a 4-week moving average, and we're there. You can see where the 4-week was last week and how price responded at that level. Below that is the 20-week. And then we've got the 50-week at 41.33. Talked about this last week, the 200 period moving average. So we made it through the SMA, but we made it through the EMA, but we still had the SMA overhead. It's still there. That hasn't changed, but now we got both of them again overhead since we failed through the 200 EMA. That 50-week proved to be a solid resistance level and be a heck of a thing to get through there. Very likely it's going to take some of that econ that I mentioned earlier that's on deck, right? We got CPI in the next 3 weeks, FOMC. In the next 3 days, we've got Powell at an event, and it's really being promoted as an opportunity for him to kind of like open forum, a little bit like Jackson Hole. So, you know, he has the capacity at that event. If he thinks that this market has really started to get exuberant again, that everybody's looking up thinking now's a good time to be buying these beaten down tech stocks and blah, 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 he might decide to give the market another swipe, just like he did at Jackson Hole. So with these China ADR names being down, you're looking at Alibaba, which is one of the premier names that we always look at when it comes to what's going on over in China. It's a bellwether stock, right? So keeping track of what's going on in Baba is like keeping track of what's going on in China. But behind that, there's a lot of other China names worth keeping an eye on. PDD, Baidu, and then some of your lesser ones like Neo, right? Kind of go down the list. JD would be another one. Then there's the ETF. KWeb is what we use. And KWeb is up this morning. This kind of goes into that conversation that we've been having over the last week or two about how strong the flows are out there. I mean, sure, everybody's out talking about how negative everything is, but that's not where their money is. If you look at where the money is, everything's bullish, really, really bullish. Lots of bullish flow coming in. So it's this, watch what they spend, right? Not what they say. all those talking heads on TV, they're just talking out of the side of their face because their money is positioned for long plays. It has been, and that hasn't changed yet. It could change today, all right, with more news coming out of China this morning. So we could begin to see a change, but we haven't seen that yet. So don't take this gapped down market this morning as an overly bearish signal, because so far we're not seeing it. It is concerning, though, that with the drop in the dollar that we saw, that we didn't rally back up, right? That drop in the dollar should have been like pouring gasoline on a fire. And it did nothing. So a little bit of concern on that bullish flow, with the idea that the market didn't respond to that falling dollar at all. All right, so Tesla gapped down, inside day breakout. But if we back it up to Wednesday, we're still just sitting inside Wednesday's levels, right? And remember, we want to kind of discount all of the shenanigans from, the half day Friday, and just focus on the last good close, right? I need to quit saying that was Wednesday, but Wednesday was a full day, right? So it counts. I need to quit saying yesterday, not Wednesday. So I'm sure I'm going to accidentally reference Friday a lot, but we really want to focus on Wednesday. With that in mind, we're back inside, like an inside day breakout. We left it, we came back inside of it. We've still got some gap that needs to be resolved out here over our head. And thanks to the way that Tesla gapped, we're now kind of trapped in between two different zones. This is setting up for a TRB. A TRB would be a trend line breakover. But to get it, we would need to see a consolidation 1 or 2 weeks sideways, kind of holding the line. It can wick lower, just not close lower, right? So 165.50, kind of the line in the sand. We don't want to see it closing below that on the week. But if we can base down here, staying between 192 and 165, I know that sounds like a big range, but I'm on a weekly. The breakover is very much like a catapult. It would just send this move upward really, really fast. And there's a weekly gap to close. 254 is the start of it, and then 262 would be the end of it. So that'd be the channel that we would focus on, but we need to start that crossover first. Here's an example of how fast price moves in a TRB, right? There was the trend line, there's the base, then it breaks over, and it's just a really fast move in a short period of time. We're not there yet. Obviously, just kind of keep an eye on it. And if Tesla stays below 200, then we're going to continue to stay bearish on it, looking for new opportunities to short this thing, right? So it's going to continue to be sell the rip, not buy the dip, until it gets above, at the very least, 200. And that would only give you your first higher high. So, you know, it's not a lot of conviction in that. And yes, Tier 1 Alpha actually put out an email while I'm still streaming. Yay. All right, so this is a free email from a company called Tier 1 Alpha. They usually write up a little bit of a story, put some background into it, but they also put out gamma levels. So you've got your S&P gamma bands and your gamma 0. So that's 3 pivot points, upper band, lower band, and a 0 gamma. And then you've got your S&P volatility bands, and those 2 levels can be added. So altogether, this is 5 pivot points that you can add to your charts every day that are not based solely on price, right? Like most of our pivot points are based on price action, open, high, low, close, a measured move candle, you know, something like that. These are based on their volatility tools and their GEX and DEX and gamma bands. They don't necessarily have a lot of background on their tools necessarily, like, you know, researching them is a little tricky. But at the very least, you can mark those levels out on the chart, read about what they have to say each day. The emails aren't normally very long. And they do provide extra levels for, say, the FANG stocks and the XL series, right, for the sectors. And it's free, right? Just go and sign up for it. They'll just send you an email every day. That has some long tail right there. They're basically saying here that market breadth is basically overbought, that we're kind of hitting into the extremes and that we need a pullback. This is where they're talking about how many stocks are making a new 20-day high and how it's still showing a lot of strength. It matches right in with what I was talking about when I'm beating the drum saying, be careful, all the money is pointing to a bullish move. They might be out there talking bearish, but they're talking out of the side of their neck because their money is all positioned long, which is a little bit of a danger because if we actually do start to break and head lower, they're all off sides. And it'll be an epic race to see who can sell first. A short squeeze or a long squeeze in this case, like we haven't seen it in a while. It'll be epic. It's an absolutely phenomenal squeeze. But it'll happen really, really fast, like a flash crash style. And they do talk quite a bit about the VC funds, volatility control funds. Those guys, they have to buy and they have to sell based on volatility levels. They don't get to pick and choose. They don't have discretion like we do. They have rules that say if volatility does this, you buy or you sell, and that's what they have to do. So a lot of those funds are continuing to buy just because they have to. As long as volatility continues to fade, they have to continue to buy. Add their buying in with the CTAs telling everybody to buy, adding in with, the lower fuel, performance chasing into the year. A lot of these funds haven't even been able to beat the S&P on the year. And what do they tell clients when they can't even, match benchmark performance metrics? Why have some money manager managing your money who can't beat SPY when you could just take your money and buy SPY? So you got performance chasing, and then there's still a ton of people that are disgruntled that they missed the rally from the March 2020 lows. And they're just swearing up and down they're not going to miss this rally. And they're continuing to stay long positioned for a rip move up off of these lows. So a lot of reasons and a lot of money still pointing up. Which, kind of begs into question, what's Powell going to do Wednesday to get these people to let go of that long bias? Remember, their job right now is wealth destruction. They want to put the fire out in this red hot money spree. They want to soak up or absorb all of that COVID money that they helicoptered out to the American people. Destroy jobs, destroy wealth, slow everything down. So we'll see what he says Wednesday. Leading the drop this morning is natural gas. Below that is USO crude. We got some energy names. Bitcoin down 2.5. More energy names, airlines, and then energy again. So it's like across the board. I'm seeing solar, coal, crude, everything getting whacked on the energy side. Tech is down more than finance. And emerging markets is not down as much as I would have expected, right? Emerging markets has got a lot of China in it. And KWEB not being down at all is just a shock. And this kind of falls into that argument about the long positioned money. All right, we got the dollar open at 8.20. It's making its moves up off of these lows. Now, when the dollar dropped, it should have fueled a move higher in the S&P and in the NASDAQ, and it did not. So now that it's rallying, got to kind of wonder if this rally is going to push the S&P and the NASDAQ down. It didn't buoy it up when it should have, but will it knock it down as it normally would? It's certainly giving Japan fire. Not really helping China out yet. Not as much. And remember, things that are decoupled can reconnect, right? So if this dollar starts to impact the S&P and the NASDAQ, you're going to want to pay particular attention to the pivot points within US dollar Japan or US dollar China. Right now, it's just moving towards the 4-period moving average. But if I got rid of all the extra lines in there, I've got a monthly level at 138, basically 139 in US dollar Japan. That's going to be a hard level to get through. And for the US dollar, or excuse me, the US dollar index, the Dixie, it's going to be getting back above that 106. So we're going to look for a rejection in the dollar. If it rejects 106 and starts to fall, S&P and NASDAQ are likely to find support and bounce back up. That would give us more of like a double bottom play. I like come down and bounce off kind of thing. If the dollar comes up and rejects and begins moving back down again. Apple is one of the last holdouts. So when you're watching Apple today or you're looking to trade Apple, keep in mind that this is the market. If Apple goes, we're finally going to get that capitulation drop that we've all been looking for. I've heard this referred to as the general, right? But I usually call it like the darling of Wall Street. Everybody loves Apple stock. Every major fund and firm and institution holds Apple until they don't, right? Until the day they say, screw it, and they dump it. Well, I've heard this great question, and I love the question so much. I use it now all the time. If they're dumping Apple, if they're not willing to hold this, why would they buy anything else? Right? It's not like they're going to dump Apple to go buy Baba. So keep your eye on Apple moving to the downside. Gave out benchmarks on that last week. I think they're still solid. There's no reason to reinvent the wheel there. Everybody be careful, be safe, have a good week. I'll see you all tomorrow.